Hi, welcome back. It's the start of the year, and for those of you who've tracked me for a while, you know what I spend the first week of the year doing, right? I play Moneyball. Basically, I collect data on all publicly traded companies and I slice and dice the data to see what I can learn about the previous year. I knew going into this year that it was going to be a challenge because 2020 was the most unusual year. Why? Well, in February of last year, global economies started to shut down. That affected company operations, and initially markets went into a tailspin. Well, there was a second problem. The second half of the year, markets came back strongly, but companies were still affected by the shutdown. So there's a disconnect between operations and markets that make the numbers a little tricky. That said, I'm still going to do what I've always done, is look at the data. Now, before I take you on a path, what I found in the data, let me be quite open about what this data can help you with. It's not going to help you make money. And here's why. I know that everybody's a believer in big data now. But I'm a cynic, perhaps a skeptic on big data, because I think there are two conditions that have to be met for data to make you money. The first is the data that you have has to be exclusive, something you and only you have access to. There's a reason Amazon and Netflix use big data. Well, the data they collect is exclusive to them. Second, you have to be able to act on that data. You can't pay dividends with data. You can't pay employees with data. You got to convert the data into products and services or augment your existing products and services and make money on it. So data is to be exclusive and it has to be actionable. Already I'm laying the foundations for why I don't believe I can make my money by looking at the data from last year. All of the data that I'm using is public information. Anybody with access to a big database, and I know these databases can be expensive, but there are literally millions of people have access to it through their work or through their jobs. And they can do exactly what I do. So I'm going to go in with open eyes. This is not about making money. So why bother? There are 4 reasons why I look at the data. The first is to gain perspective. Whether you're a company or an investor, when you approach a decision, you have to have a sense of what's normal, what's high, what's low. Let me give you a couple of examples. You're an investor, you're looking at a stock, it has a PE ratio of 15. Well, before you decide whether to buy or sell the stock, you have to get a sense of what a typical PE ratio is in the market, what's high, what's low. You're a company trying to decide how much to borrow. Before you decide to borrow, you have to get a sense of how much do companies in my sector borrow, what's typical, what's high, what's low. Looking at the data gives me perspective. Second, more and more we're specialized as investors, as analysts. Investors are creatures of habit. They get focused on a particular market and often on a sector in that market. And analysts are even worse. They're given a job of focusing on 15 or 20 companies and that becomes their entire world. So what? You develop tunnel vision. Everything you know comes from looking at the companies you focus on. And after a while, it's easy to lose sight of what's sensible. For instance, if you're an analyst who follows young tech companies, you might believe that 10 times revenues is cheap because every company you look at trades at 30 times revenues. Looking at the data, looking across markets and across sectors is one way of clearing tunnel vision. Third, and I'm not going to sugarcoat this, we hear a lot of BS. We heard from experts, we heard from market gurus, we heard from analysts. What they do is they take anecdotal evidence, just make up stuff and use it to push an agenda. So for instance, you've heard that US companies are now much more highly levered, have more debt than they did 10 years ago. Is that true? You probably have heard that companies who do buybacks are financially less healthy than companies that don't. Is that true? There are big questions, but I don't think these experts have the answers. The answers lie in the data. So in my attempt to push back against these assertions, I'm going to look at the data to get a sense of what's really going on. And finally, I want to challenge conventional wisdom. Let's face it, investing is full of rules of thumb. You should invest in the stock market if the PE ratio or the CAPE, the adjusted PE ratio, is greater than 16. You should invest in an individual stock if it trades at above book value. A stock that has a PEG ratio less than 1 is cheap. I don't know where these rules of thumb came from, but my guess is they originally came from looking at the data then. Who knows when? 1960s, 1970s? The world has moved on. Many of these rules of thumb no longer work, but we continue to use it because inertia is such a strong force in practice. Just as a small example, if you're an appraiser or an analyst, you're taught across the world when you value small companies to add what's called a small cap premium, about 4 to 5% to your discount rate, because small caps stocks are supposedly more risky than large cap stocks. That process originated in the 1980s based on data that showed that small cap stocks in the US earned a premium of about 4 to 5% over large cap stocks. But that data was from 1926 to 1980. You know, the small cap premium has disappeared. It's been gone for 4 decades. But people continue to use the small cap premium. Looking at the data can often be the way to kind of challenge these conventional practices. So let me cut to the chase and talk about the data, because that's what this whole session is about. First, I want to dispense with the notion that just because you're working with numbers, you're somehow objective and a scientist. Let me be quite clear. If you have biases and preconceptions, having data is not going to make them go away. In fact, with those biases and preconceptions, you're going to latch on to the numbers that feed your biases. And the stronger your biases, the more you will find numbers that back you up. It's just an example. One of the things that I report on my website is tax rates paid by companies in different parts of the world, different sectors. That is one of the more widely used data sets on my website. It's downloaded by journalists, by economists, by politicians. And they often will use that same table to make their cases, even though they're on different sides of the argument. So those people who believe that US companies, for instance, pay too little in taxes will find a tax rate that I measure that backs up their argument. But because I report different measures of tax rates, somebody who believes that companies pay too much in taxes will find a different number to back it up. I can't control for that. But if you do find numbers from my website used in a journal article, in whatever argument, go to the source and make your own judgment. So let's talk about the data. One of the problems when you start looking at public companies is people slice and dice. They tend to focus on larger companies over smaller ones. That makes sense, right? Because movements in larger companies have bigger consequences. They tend to focus on publicly traded companies and ignore private business for a simple reason. There is less information available on private businesses and they're not as actionable. You can't invest on that information. They focus on companies in developed and more liquid markets because there is more information out there. The problem, though, is when you narrow your sample, you create biases, whether you like it or not. So I'm going to keep my sample broad. In my sample, I include every publicly traded company in the world that has a market cap. I don't slice and dice. Are some of these companies strange companies? Obviously. We'll talk about how I deal with them in my statistics, but I include all of them. And at the start of 2021, there were 46,579 companies in my sample. Just to give you some perspective, last year's sample I had 44,400 companies. In 2020, a most unusual and trying year, my sample size actually increased by about 2,200 firms. Now a little bit more about the sample. Geographically, there are companies from 136 countries. And broken down regionally, you can see the breakdown looks pretty diverse. But broken down by market cap rather than by number of firms, you can see that the US was the dominant geographical area, accounting for 40% of global market cap. China is close, 18%, but it's close only in the sense of it's closer than it was last year. This is a sample that's skewed towards the US because that's where the largest publicly traded companies exist. Finally, I broke down my sample by sectors. These are the S&P 500 sectors. And you can again see a pretty wide, diverse breakdown in terms of number of firms. But the largest single sector at the start of 2021, and this should come as no surprise to you, is technology. It accounts for 17% of the market cap of all publicly traded companies globally. I said this was the last. I was lying. There's one more breakdown I did where I looked at company age. One of the things that we need to keep in mind is as new companies enter markets, especially emerging markets and new businesses, that's what's causing the sample size to increase. But as you look across the sample, you can see that there are some fairly old companies in my sample, companies that have been around more than 100 years, as well as companies that have been around for less than 20 years. Later, when I talk about the data, I'm going to break down what I find by company age to see if there are wide differences, but something to file away. It's a pretty diverse sample in terms of company age. Now, before we look at the variables that I will be reporting, some general observations about the data. When you look at 46,000 plus companies across 136 markets, one of the challenges you face is the numbers are often in different currencies, market cap numbers, operating numbers, and you cannot add together numbers in different currencies. I cannot add dollar values to rupee values because that would make no sense. There are two techniques I use to get rid of this problem. The first is I convert all numbers into US dollars. That's not parochial, just to make it a common currency. I could have picked any other currency. I picked the US dollar because it's the easiest currency for me to get the raw data on. So all of the value numbers, whether it's revenues or market cap, are in US dollars. Second, most of the statistics I measure will be ratios. You're saying, so what? A PE ratio does not have a currency. If I take a Turkish company and divide its Turkish lira market cap by its Turkish lira earnings, I get a PE ratio, but it's not in Turkish lira. It's just a ratio. I can compare that ratio to a US company where I take US dollar market cap and divide by US dollar net income to come up with a PE ratio. So ratios will not require a currency. And while there will be risk effects, a Turkish company will be riskier than a US company, that's independent of the currency issue. Second, when you're looking at 46,579 companies, since information disclosure requirements vary widely across markets, there will be missing data for some companies or many companies and on at least some variables. Now, one choice you have is remove any company with missing data, but I would lose more than half my sample. So here's what I've done. I've left those companies in the sample, but for those statistics where I cannot get the data, I report not available or missing. So I'll give you an example. For 30 years now, I've converted lease commitments to debt, a practice that accountants have finally adopted, at least in some parts of the world. But to do that, I need to know what your lease commitments are in the future. That's disclosed by US companies and some European companies, but in some emerging markets, that data is not available. It's not because I'm not trying, it's just not available. So you know what I do? I compute the lease debt for the companies which have the lease commitments, and I report missing for those companies that don't have lease debt. It's the best I can do with missing data. When you're comparing companies across 136 countries, there will also be accounting differences. Now, I would hasten to add that the differences in accounting across countries has narrowed over time, with IFRS pushing countries to adopt common standards. But there's still differences. Is the net income for a Japanese company directly comparable to the net income for an Indian company? Probably not. But there's not much I can do about that. The only defense I can offer is because my sample size is so large, I hope the differences get washed away by the sample size. And finally, I don't collect the raw data on 46,579 companies. I cannot do that. I am dependent on my raw data providers, and I'm incredibly thankful that I have Bloomberg and S&P and FactSet and the Federal Reserve to provide me with the raw data. That said, though, with this many companies, there will be errors in the data. Again, I hope the sample size takes care of it and washes away the errors. But there might be significant errors that still go through. It's also possible that in some of these companies, management might be cooking the books. There could be accounting fraud. Nothing I can do about it other than hope the averaging takes care of it. So let me talk a little bit about the data you will find on my website from this year's update. I don't do much macro data for a simple reason. There are much better sources for macro data. I've talked about the Federal Reserve. FRED, which is the Federal Reserve data site, is a gold mine for macroeconomic data. If you've never visited it, please do. So I don't spend time reporting GDP and inflation and other numbers because the World Bank does it, the IMF does it, the Federal Reserve does it. I do report a couple of numbers that I find useful in the context of valuation. The first is US equity risk premiums. The conventional way in which this equity risk premium is computed is by looking backwards, a historical risk premium. So I update the numbers to include 2020 and I report a premium that stocks have earned over treasury bonds and T-bills going back to 1928. I also report a forward-looking or an implied premium, and I have updated the premiums to bring them through January 1st. And I will also provide premiums computed by day for 2020, a most unusual year again. I also report equity risk premiums for countries, which is basically if I'm looking at a US company operating in multiple countries, or I want to value an Indian or Indonesian company, I need to know equity risk premiums in other countries. I won't bore you with the details because there'll be another post that explains the detail. But I've estimated equity risk premiums for about 155 to 160 countries and updated them to January 1st, 2021. I also report the price of risk in the bond market, which is captured in the default spread. And that default spread, I report both the historical data by looking at what returns AAA and BBB bonds have earned relative to T bonds going back to 1928. But I also report forward-looking estimates of that default spread based on yields on these bonds today, as opposed to the T bond rate. That's the macro data. Much of my data is micro data, and before I talk about what micro data I report, let me talk a little bit about how I would present the data. Obviously, giving you data on 46,579 companies is information overload. It's not going to help you. Besides, I couldn't do that even if I wanted to, because I'd be stepping on the toes of my raw data providers. So I consolidate those companies into 94 industries. Now, those industries are created based on the industry classification that are in my raw data. But basically, I break down companies into 94 industries. I also break down companies by geography, and rather than report them individually for 136 countries, and I do have one table where I do that, much of my data I would break them down into broader geographical groupings. The US, Europe. I also report Australia, New Zealand, and Canada as one grouping, Japan, and what I call emerging markets that includes the rest of the world. That's a lot of countries in there. So I do break down India and China as subsets of those and report the data on those groupings. I also look at compute averages for each of the groupings, but a little bit about the averages, and I don't mean to insult you by explaining how I do it because it's not as simple as it sounds. Just to illustrate, let me give you an example. Let's assume I want to compute the PE ratio for all US chemical companies. You think that's easy. Compute the PE ratio for every chemical company and then average it out. That's a simple average. There are two problems to that simple average. First, that simple average is going to weight really small companies and really large companies equally, and it's going to be pulled out by outliers. All you need is one PE ratio that's 15,000 to 20,000, which can happen to draw the average out. The second is I will lose from my sample any companies that lose money because I can't compute the PE ratio. I know one way to get around this, at least the first problem, where every company is weighted equally, is to use a weighted average, weighted based on market cap. Well, that does take care of the first problem, and it does reduce the effect of outliers, but it still leaves me with the second problem. I could report the median, which removes the outliers, but still I have the second problem of losing companies. So for most of my ratios, here's what I do. I use an aggregated number. You're saying, what are you talking about? To compute the PE ratio for chemical companies, I add up the market cap of every chemical company in my sample. And then I add up the net income of every chemical company in the sample, including the money-losing companies. Then I divide the aggregated market cap by the aggregated net income. In a sense, I'm weighting because the larger companies count for more in the aggregation, and I don't throw away any companies. Finally, my objective is to present you the current data, which means when I report the PE ratio, I'm going to take the price as of January 1st, 2021, and divide by the earnings that this company had in the most recent 12 months. Trailing 12-month data is my basis for most of my ratios. Now remember, on January 1st, 2021, my trailing 12-month data is not 2020 data because the last quarter of 2020 would not have been reported. It's going to be the data from October of 2019 through September of 2020. So all of the data is based on trailing numbers unless I want to report an average, which I do for a few statistics. Now I know 2020 is a strange year, and we'll talk more about that. But if you want to look at prior year's data, the archive data is also available on my website, going back almost 20 years for US companies and a decade or so for the rest of the world. Now, in terms of micro variables, I really do this for myself. So I report the variables that I use in valuation. So risk measures, I use betas. And now you're already rolling your eyes, says, who cares about betas? If you don't like betas, don't use them. I report standard deviation of the stock price. If you believe income is your measure of risk, I look at standard deviation operating income. I also report a high-low risk measure where I said companies where the stock price moves a lot are more risky than companies where they don't. I also report cost of equity, cost of debt, cost of capital. On profitability, I report net profit margins, operating margins, EBITDA margins, you name the margin, I report it. And on returns, I compute accounting returns, returns on equity, returns on invested capital, and excess returns, what you earn over and above your costs. Finally, on pricing, I report PE ratios, PEG ratios, EV multiples, pretty much every multiple that you could be interested in, broken down again by industry and by geographical grouping. On leverage, I report every conceivable measure of debt ratio, debt to capital, debt to EBITDA, interest coverage ratios. On cash flows, I report capital expenditure numbers and net capex numbers, including acquisitions, working capital numbers. And on dividends, I report both traditional dividends and buybacks, scaled to earnings and to market cap. Finally, on risk premiums, as I mentioned, I report equity risk premiums and bond default spreads. And a little bit about COVID and how it's impacting this year's update. First, the global shutdown did affect companies, and I report both market cap effects and operating effects. And I break down the market cap effects by looking at sub-periods of 2020. January 1st, 2020 to February 14th, before markets woke up to the crisis. February 14th to March 20th, the heart of the crisis. March 20th to September 1st, the recovery. And the continued recovery from September 1st through the end of the year. I look at differences across sectors and across geographies. Now, incidentally, if you're looking at operating metrics like margins and returns on capital, remember they will be affected by COVID since I use trailing 12-month numbers. Now, I've left them as is, but I give you the option of going back and looking at 2019 numbers if you want something that's a better long-term target. Finally, on the pricing ratios, think of what's happened. Market caps are recovered for many companies, but operating numbers are still damaged. So when you compute metrics like price earnings ratios or EV to sales or EV to EBITDA, don't be surprised to get really high numbers, and you will see this in my tables. Now, if you're comparing across companies today, this is not a big deal. But for those people who come in with strong preconceptions of what is cheap or expensive on a pricing basis, everything is going to look outlandishly expensive at the start of 2021. I'm amazed to see people using trailing 12-month PE ratios, for instance, to make an argument, but there are people who still do. In terms of data access, the data is free. All you have to do is go onto my website. You can click the link and you can see the data online, but I would strongly recommend that you download the Excel spreadsheets. Why? Because the data that you see online is only for US companies, but the spreadsheets, you can download the spreadsheets by geography. The US, for Europe, for emerging markets, Japan, Australia, New Zealand, or global. The Excel spreadsheets are much richer because I describe the variables and even have a YouTube video inside each of the spreadsheets explaining what I do. I know people download this data and use it in a variety of contexts, and I'm completely okay with that. If you're an analyst, if you're an appraiser and you want to use my data and it saves you time, all the more power to you. I'm glad I saved you some time. Use it well. You spend it with your family, have some fun. If you're using my data to buttress an argument or to debunk somebody else's, I wish you the best, but don't drag me into it. If you're using it in a legal setting, as an expert witness, go ahead and use it. But please, 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 please don't bring me in there. I'm a believer that courts are the graveyard for good valuation practice, and I have no desire to be part of that process. I know as you look at this data, you will have questions. Now, before you get mad and fire off a question to me, remember, or to my team, remember, this is a team of one. And there's only so much I can do. So if you want to have something specific created for you, I can't do it. I don't do customized data. But for most of your questions, the answer should be online. But if you cannot find the answer, please do send me the question. I will try to answer it and hopefully add some details so the next year that data is easier to work with. Final thoughts. No, before you jump out and give me sainthood for giving away the data for free, I'll make a confession. This wasn't difficult or tedious to do. I enjoy doing this. And with the raw data available, it's not that big a deal. To be honest, I would have done this for myself. And I do it because I need it for my evaluations, for my analysis, for my teaching. So if I'm going to do it for myself, what difference does it make for me to offer it to you? It costs me nothing and it might save you some time. As I said earlier, it's not as if I could make money off this data. That's not the intent. So I hope you find the data useful. And if you do, you don't have to thank me. I'm okay with that. You don't even have to acknowledge me. Act as if the data is yours. It doesn't bother me. In the next few posts, I'm going to talk about what I see in the data. But I am both a believer and a pragmatist in data. I believe in looking at data, but I also recognize its limitations. I hope you use the data well and pass it on. Thank you very much for listening.